Here's a complete summary of everything that Jerome Powell said today. A few quick notes. First, he did not mention the Philadelphia Fed survey or the Conference Board surveys. In case you didn't hear those, the Philadelphia Fed non-manufacturing, so think services, survey indicated weaker employment, weaker revenues, but more optimism. And really what I noticed in the chart was if you drew sort of a red line across the chart, there really only been two prior times where we've been in a situation where both of these lines, future activity and current activity, are below the red line. COVID, and then briefly in 2022 as we started raising rates and stocks were falling off a cliff. Somewhat interesting to see this on the Philly Fed survey because you kind of also saw some of these hints in the Conference Board survey. Again, neither of which Powell mentioned, but I think some of the things he talked about are starting to indicate he's getting a little closer to the realization that, crap, we're going to have to cut rates pretty soon. Because look at the Conference Board survey. Here are the numbers on the Conference Board survey. But what matters, in my opinion, is not just that confidence came in lower than expected, lower than prior, present situation lower than prior, and expectations lower than prior. What matters is right here. Confidence weakened in June, erasing almost half of May's sharp gains. Expectations on consumer short-term outlook for income, business, and labor market conditions fell to 69, substantially below the threshold of 80 that typically signals a recession ahead. The cutoff date for the data was June 18th. So the data was collected between June 9th and 18th. So in fairness, you've got a little bit of a headache involved in there, not too much towards the end regarding the strikes by Israel on Iran. We'd be looking somewhere at, kind of during that period, maybe half of the data would have been affected by some of the concerns over Israel-Iran. So it's unclear how much, obviously, impact that would have on the survey. But you do notice, it's a recessionary confidence board survey, and Philadelphia Fed survey this morning was a little weak. Yesterday, we also had a little bit of a weak one. So when we put this together, it might make sense why we're starting to see some of this shift in some of the Fed commentary. Remember that on Friday, we heard Governor Waller say, we might want to cut in July a little sooner than expected. Yesterday, we had heard Bowman and Goolsbee both echo that. And today, Hammack came out, also on the Fed, suggesting that the latest inflation readings are encouraging. And now, this is the fourth Fed official in 3 days to pitch, hey, inflation's low, maybe we should cut rates. This is odd. This is a really odd, sudden Fed flip that's building. And it's getting worse and worse, I feel like, by the day. Hammack says that the labor market seems stable right now, but immigration restrictions could end up being a barrier to growth in the medium term, which could lead to a rise in the unemployment rate, and again, the Fed needing to cut. Now, something that I see in comments is people mistake the Federal Reserve reducing rates with money printing. These are very different things. The Federal Reserve was cutting rates in 2001 to try to minimize the pain of the dot-com bubble, and it did nothing. What's important to remember is the stock market continued to sell off throughout 2001, 2002, and basically through early 2003 when you finally bottomed out. What was the catalyst for bottoming out? The money printer turning on. So they're different things. You can cut rates. And that doesn't necessarily do anything for you immediately. There's generally, as Powell always says, a long and variable lag. And even if rates are low, you don't necessarily know that businesses are going to borrow and people are going to take advantage of it if they're uncertain. So what happens is you're in this weird environment where you can actually cut rates down, just like we did in 01. And you don't actually sustain the stock market or the economy. What matters is actually turning the money printer on and basically getting into the ditch, bailing stuff out directly. And that is the precedent that has been set by the Federal Reserve since the 80s, that when things get bad enough, they will come and turn the money printer on and shower everything with cash and make it all okay again. Just know that's different from rate cuts. Now, that kind of then begs the question, so are rate cuts bullish or bearish? Well, generally, we think of rate cuts as bullish because rates go down, people can borrow more money on margin or real estate debt or whatever and invest it. But why are they cutting? And that's where we're starting to get these hints that they're starting to freak out about jobs a lot. In fact, Jerome Powell went as far as saying that artificial intelligence will replace a lot of jobs. There was no question in his opinion there. He said it will replace a lot of jobs. And in the short term, we could see significant reductions in employment, and that's what he's hearing from CEOs as well, which again sounds bullish cuts, but it's also bad recessionary, right? In that near term before you get to the money printer. Now, he does say that longer term, AI will probably create jobs and we'll see more productivity from people, which is a good thing. But in the meantime, we're just going to pay attention really to any meaningful increase in inflation on the goods channel over the next, essentially 2 months. So this is actually really interesting because you should mark these two dates on your calendar. You should mark July 15th because that's when we're going to get the June CPI report. And you should mark August 12th because that's when we're going to get the July CPI report. So mark those calendars, those dates on your calendar, July 15th, August 12th. Powell says we expect a meaningful increase in inflation through the goods channel in July and June in those reads. Now, why does that matter?